Guardieri. He is director and senior economist at BMO Capital Markets for his insight. So you've heard the headline number, Sal. What is your take on that number? How does it line up with your expectations?
A little weaker than expected, and I mean 2.6% growth overall is not bad. In fact, it's generally stronger than the long-term average for the U.S. economy. But it really exaggerates the strength of the U.S. economy that quarter, because much of that simply originated from a big increase in inventories, business inventories, which is not sustainable, a big increase in government spending, which is likely not going to repeat, and a drop in imports. So all those drivers basically pumped up the number in the fourth quarter. If you look beneath the surface at the combination of, say, consumer spending, business investment, residential construction, I presume it still remained very weak, because the previous estimate, the second estimate, was basically flat for that private domestic demand number. And that was following a couple quarters of weakness as well. So it's pretty clear the U.S. economy lost momentum through 2022, even though the headline numbers for the second half of the year were much stronger than the first half of the year.
And you are expecting a modest increase in first quarter gross domestic product. And indeed, Bloomberg News is reporting that a survey of economists by Bloomberg News results in a consensus call in that survey that the U.S. economy will expand by 1.0% in the first quarter. Is that in line with your expectation?
We're a little weaker than that right now, at about half that pace, but there's definitely some upside risk there. We do know that American consumers got off to a very good start this year, partly because of the warmer weather in January. But as well, they're tapping into those excess savings, and there's still some deferred spending on services, travel in particular. But we do know that consumers then pulled back in February, and we are counting on a big pullback in business inventory investment in the first quarter. So I still think we're due for a fairly soft increase in GDP in the first quarter. It'll be slower, most likely, than the fourth quarter number, but positive. Unfortunately, though, I think that could be the high point for this year, because we do believe the U.S. economy will likely slip into a very mild, shallow downturn by the second and third quarter of this year, largely in response to the massive run-up in interest rates, partly because of high inflation, but also now because of somewhat tighter lending conditions because of the recent bank stress.
Interesting. I want to correct something I said as well. The survey by Bloomberg concludes that economists expect gross domestic product for all of 2023 to expand by 1.0%. The first quarter call, again, this is a consensus, this is the result of a survey by economists. The first quarter expectation coming out of that survey is for growth of 1.3%. So 1.3% in the first quarter, 1.0% for all of 2023. Sal Guardieri has just told us that he believes the first quarter number will come in softer than that. So you are calling for a mild recession in Q2 and Q3. Is that correct, Sal?
Yeah, that is our view at the moment. As far as the first quarter is concerned, we will get the February number for American consumer spending out tomorrow. So that will carry a lot of weight in our estimate for the first quarter GDP. We could easily bounce it up, but again, that's almost history now. And our concern is more what happens through the spring and summer of this year. And we do think the economy will slip into a mild downturn.
So what's the read-through here for inflation, which is top of mind, of course, for investors? What is the read-through from the dramatic softening in gross domestic product growth that you're expecting and the path of inflation?
Well, unfortunately, recessions are the surefire cure for high inflation, and we do expect inflation to continue to drift downwards. Unfortunately, that will be as a result of some pain, largely on the backs of workers. We do expect the unemployment rate to drift up by about 1 percentage point in the U.S. For this year. That will take some pressure off of wage growth. Will make businesses will lose some pricing power as well. Consumers will push back a little harder at price increases. So we do expect inflation to continue to moderate this year. But even by the end of this year, we still see a 3 handle on the CPI rate. Probably won't be until more into next year when we see inflation getting closer to that 2% target. So for the Fed, that does carry implications. We may not see much further rate increases in the U.S. We are calling for 1 more quarter-point increase in May, but that could be it for this year. Unfortunately, the Fed may not be able to cut interest rates as early as it would like to, and we do not expect a rate cut this year simply because of some stubbornness in the inflation numbers.